Vinay Jaising, CIO and Head of Equity Advisory at ASK Private Wealth, Johnson right now on the show in his new avatar. Vinay, great talking to you. It's been a while, but thanks for taking the time out.
Really appreciate you taking us out.
No, not at all. Vinay, constructive currently or skeptical? Because there are too many moving parts, as usually there are, but right now even more so.
So pretty constructive, more so on stocks than on the indices, and largely the reasons are pretty simple. If you had turned back the clock last year, you had one engine firing the Indian markets, which was retail. All of a sudden, with the currency being where it is, virtually flat on a year-on-year basis versus the dollar, and the DXY having moved down by 10%. You've seen FIs in the last 2-3 months put as much as $4 billion. So now you have two engines firing the Indian capital markets. So these are two solid reasons. The third solid reason to be constructive is you've seen crude prices correct by 15 to 20%. Which is again good news or music to the eyes of the Indian coffers. The fourth reason is you're probably close to the end of earnings cuts coming up for estimates for EPS for most companies. Finally, you've seen the banking system flushed with liquidity. So all these, are very positive for the capital markets. One clear, not so positive moving part is valuations, because if you see the last 3 months, the Indian small cap and mid cap are up between 15 to 25%. Not just us, but MSCI World is close to peak levels today. So valuations are not as attractive as they were earlier.
Vinay, good morning. Hiral this side. So valuations are not attractive. However, if you have to look at India in terms of resilience, do you think we are way better off as compared to other emerging markets then? And with the kind of fund flow movement that is expected to happen as well, where would you then find pockets of opportunity right now?
So three questions. First, valuations are not as attractive, but India's resilience clearly is great. If you look at the incremental GDP India is adding on to the world, it's somewhere to the tune of 10 to 20% based on the world growth being 1 to 2%. Take an average number of 15% of the incremental world's GDP coming in from India. That's a very big sign. In terms of profit pool, it's just 1.5, 1.6%. And in terms of inflows, last year was negative, but average is about 1.5%. So you can see a lot of inflows come into the country. Second point, if you look at indices, most indices in emerging market have moved India up from 6-7% to as much as 18%. And at the same time, if you look at the data of Indian FIs in the shareholding pattern, that's gone down from a peak of 20 to 16, again, a 12 to 14-year low. So this also gives you the fact that, FIs are underowned the country, and the GDP is growing pretty well. One last indicator, which is very pro-India, is if I had to just look at the 10-year interest rate of India versus the rest of the world, or let's talk about US currently. 6 years ago, it was 6%, the interest rate differential between India and US for the 10-year. Today, it's as low as 1.8%. So it also tells you the risk premium for India has come down substantially.
Okay. So that's with regards to where, India stands in terms of resilience, the key positives that you should be looking at. Let me talk to you about individual sectors. Right now we were just talking about how real estate as a sector is seeing some good numbers in terms of the pre-sales data that has come in for the first quarter of FY26, but a lot of negatives that were there in FY25. Would you say this is going to be a space which could be looked at from an investment perspective, taking into consideration the downtick in terms of performance? And if so, where would it be? Would it be affordable housing? Would it be the mid-segment? Or would it be luxury?
So my focus would be on affordable housing. Again, a couple of reasons. One, interest rates in the country are coming down. Second, you've seen the Indian budget focus a lot more on SOPs being given to affordable housing. And third, the fact that India is moving up on the per capita segment, that's where the demand would be incrementally a lot more. And finally, if you see the supply, the supply is relatively in the last 2, 3 years limited in the affordable housing segment. So for me, it would be the affordable housing segment space. And out here, obviously, you have NBFCs which are there. And then, you can add construction or cement companies also into that foray.
Vinay, I remember a conversation that we had some time back wherein you were amongst the voices which had gotten constructive on select CDMO, right? I'm shifting tracks now because healthcare and pharma has become a very, very buoyant topic and a topic of conversation every single day because the stocks are doing well, right? And a clutch of these CDMO names, CRO names are just doing remarkably well on the bourses and in the results. We spoke to Blue Jet, Laurus, etc., all of them sounding very constructive. Are valuations starting to look stretched, Vinay, or is the growth trajectory so long that you can still be invested because eventually valuations will correct themselves?
I didn't address one of the questions your colleague had asked earlier, but one of the three big key themes we think where there is valuations which are attractive and the earnings growth is strong is the Make in India story. With the home bias, that's where the CDMO domestically comes in. And similarly, there would be CDMOs which will be selling their products abroad. So let's just think about it for a couple of minutes. First, when you look at the domestic formulation market, let's say it's growing at 12 to 14%. But currently what these domestic formulators, the big ones, are doing, they're producing about 60 to 65% of their products, and about 30 to 35% of their products are outsourced. That number of 30 to 35%, let's say 5 to 10 years forward, our analyst Sudarshan believes would probably go to 45, 50%. And these CDMOs are much smaller than the domestic formulators. So if you have a growth of 12 to 15% for the formulators, the CDMOs, the high quality, the top 5 ones are growing at probably 25 to 35%. And if you look at their profit growth, that's a little higher because of the leveraging impact, which means their ROCE is all set to move from about 15 to 20% to 25 to 30%. So, they all go well with people who look at growth at reasonable valuations. Much higher earnings growth than the domestic formulators, ready market, doesn't need to spend as much on marketing and advertisement, focused purely on R&D, and they get multiple players who give them contracts to make the same product. So for us, CDMOs, be it domestically or globally, is a key theme in our overall structure.
Okay, so I'm guessing what you're saying, Vinay, quote unquote, or not quote unquote, but implied, is that despite valuations looking stretched, it's a pocket that could be worth staying invested in, or selectively stocks could be worth staying invested in.
Absolutely, because the earnings growth would surprise you, which means there is a return on capital employed would surprise you, which means the PE you're looking at is not really the PE which will finally come up.
Got it. Okay. In the same breath, Vinay, somehow for the last 4 years now, or maybe about 4 years, chemicals have just gone off the boil. And much as in the last 1.5 years that I've heard people say that the turn is right around the corner seems to be getting pushed every quarter. So I wonder if, as a bucket, exceptions notwithstanding, as a bucket, is the turn round the corner, or you wait for the turn to come and then log on, even if it means 5, 10, 15% more expensive?
So I would be again of the latter, as far as your comment is concerned. When we look at chemicals in two parts. Chemicals used in industries and chemicals used in the pharmaceutical sector, wherein they move on to agro or the pharmaceutical space. So I would bet more on chemicals in the pharmaceutical or chemical space because you've had early rains as well. But when you look at commodities where the price is driven by China, you want to wait, to see the price stability, to see the uptick before you move on. Again, there could be exceptions in this trade where, we need to look at our focus as India is, do we have a USP in value adding that chemical compared to the rest of the world? That would probably come, when you become an API and go into the pharmaceutical space. There we would make things look a lot more attractive. But if you're just playing as a pure chemistry, a pure chemical play where you're A, depending on China for your raw material, and B, depending on global prices, I think that's a little bit away.
Okay, so that's with chemicals. Vinay, how are you looking at, the earnings growth with regards to FY26? A lot of chatter with regards to, yes, it will be better, but again, it comes on a lower base in terms of FY25. And to add to that, if you have to look at performance from here on, the deal is going to be which are the sectors that will aid this kind of earnings trajectory from here on, because there is little room for FIs to come back as well. They have been at a decade low in terms of ownership. Where do you think they will come and put in their money? Because usually when FIs come in, you look at BFSI, you look at IT. IT, the commentary is not looking as good as expected right now.
Perfect. I was just writing down your questions. Very, very interesting ones. So I'll tell you what we are playing as key themes, and then we'll move on to the earnings part of the trajectory as well. We would look at investing in three baskets. Basket one, which your colleague just asked, I would call it just the Make in India story, wherein we have bias towards home, but the healthcare and the pharmaceutical space reaching down to the chemicals related to healthcare and agro. That we are in a way replacing the IT story for us, where you will have demand of relatively products made cheaply in CDMOs in India, sold to the rest of the world, or similar such generic stories. And I think that's where the earnings growth could be very solid, again, 25 to 30%, even if the index is growing at 5 to 10%, right? So that's step one. Step two, we would look at the capex cycle. You would appreciate, when the BJP government came in 2014, the budget for capex first year was about 1.9 trillion. Today it's about 11 trillion. In the month of March, they spend about 2.4 trillion, about 1.5 times what they had spent in 2014. So the numbers were a lot more higher in the capex. There was a time wherein railways was a big capex mode. Defense has always been a 10% growth in capex, but domestic growth is a lot more. Then there's water, there's infrastructure, back to your affordable housing question, and there's a lot of affordable housing capex being spent. So that's the space where you have companies who've got very strong orders, where the earnings growth trajectory looks also very, very good. And I think that's another space where we are constructive on. And that's where I think FIs would also come into the picture. These are B2B players, not B2C. If I look at one concern we would have at ASK Private Wealth is the B2C consumption has not yet taken off. We are not seeing data come out either from FMCG companies or otherwise that auto sales or consumption sales is increasing. If you see the loan book growth, that's gone from 20% to 10% and retail consumption has been slipping, right? We expect a capex cycle to come up, but retail consumption has become a big question mark. So for us, the third theme we think we should all focus on is financials and consumption put together. In the financial space, we would focus on two parts: affordable housing, which we already discussed, and the other is capital markets, because number of IPOs coming in, the amount of trades happening on a daily basis, the liquidity coming in, all is moving one way, which is upstairs. So that's one part of it. The other part of consumption, and sometimes you forget telecom is consumption, and some kind of discretionary spend. You would go to a hotel, but you may not spend on, buying that many biscuits and chocolates. So technically, I think that kind of discretionary spend is where FIs would look in. Funnily, if I may use that word, most of them may not be in the large cap indices. They may be in the broader cap indices. So I think FIs too would be a lot more selective in the times to come. Look where earnings growth is coming, and if the earnings growth are coming in mid cap and small cap, and not as much on particular large caps, they would be a lot more focused as well. One last comment, as far as earnings is concerned, as you rightly put it, the amount of cuts have led to, I guess, the principle of reflexivity. Now we are looking at 6 to 7% growth for Nifty 1 year forward. You'll probably be there in the first quarter of results which are coming in and inching up to probably 8 to 10%. So I think you're pretty close to a pivot of earnings growth for all the caps in the country, maybe one more quarter for it to move to a positive direction as well.
Vinay, can I very quickly, under 60 seconds, because we have an embargo to meet, but any thoughts on life insurance businesses? The stocks haven't given returns thus far. Can they change that? Quick 60 seconds, please.
So sure, I would prefer capital market plays out here purely because if you're buying a company for playing the equity markets, let it do 100% of equity market work. That's the way I would be.
Yeah, and it's been interesting to see a couple of insurance firms start off NFO as well. And that really caught my eye. But yeah, okay, capital market plays indeed. Okay, Vinay Jaising, we'll leave it at that. Thanks so much for taking the time out and being with us. Really appreciate your time.